What's going on, y'all? It's Steve Peterson here with Infinity Investments, and today's video we're going to be talking about selling multifamily properties in the pandemic economy. Now, today is October 16th, 2020. I don't know if we're smack dab in the middle of the pandemic anymore or on the tail end of it as things begin to open up here in the Bay Area. I'm in Oakland, California. Alameda County, one of the most stringent counties in terms of COVID laws. But the pandemic is definitely still raging, if you will, and has certainly affected the economy, particularly as it relates to multifamily properties. So there's 5 points that I want to talk to you guys about in terms of selling properties in multifamily properties in this pandemic economy. And let me just start with that. I say multifamily to be specific. The single family world, totally different than the commercial world. Multifamily is totally different than retail, office, and so forth. My claim to fame is multifamily, so that's what we're talking about today. So number one thing to think about in selling multifamily, whether you're listing a property for sale or you're a broker out there, is that the lenders have tightened up a lot. Now, the deal about it is the interest rates are still really low on loans, but the requirements a little bit tighter, okay? Debt coverage ratios bumped up. A lot of lenders I'm talking to today, working on a couple deals right now, and they're telling me we need 1.2 debt coverage ratios, whereas a few months ago, prior to the pandemic, it was 1.17. So the debt coverage ratios have gone up. The reserve requirements, the amount of money that they're requiring the borrower to keep in reserve has gone up. A lot of them, although typically want to see 10% of the loan amount in liquidity, in liquid cash somewhere, a lot of them have had that requirement the whole time. But a lot of people are now being a little bit more stringent. I've even seen 15% of the loan amount having to be held in reserve. They're also looking more so at the global cash flow of the owner, of the borrower, making sure that borrower is solid in the event that maybe the tenants have been affected by COVID and can't pay rent. Okay, so they're looking at the property more stringently by raising the debt coverage requirements. I've even seen one lender tell me 125, which is almost impossible in the Bay Area, but they have increased their debt coverage ratios. They have increased the amount of money that they want to see the borrowers have on the sidelines, okay, in reserves. Now, the rates are great, but these criteria are very, very stringent, okay? The second thing I want to talk to you about is vacancies, all right? In the Bay Area, in Northern California, I think the rental market in general the last couple of years, lenders haven't been their typical selves as it relates to vacancy rates, meaning that in the past, in times past, buildings have to have a certain amount of occupancy in order to get a loan. Okay, the lender comes out and says, hey, look, this building needs to be 90% occupied in order for us to consider this. In the Bay Area, for instance, in the last few years, if you had vacant units in your building, that was a great thing because, of course, we have rent control. So if you have a vacant unit, that means you can get market rent for it, no questions asked. The rental market was so hot. Lenders were lending on vacant properties and loving it because then they said, hey, this borrower can close on this deal, rent these units out, immediately get market rent. We don't have to be worried about rent control, low rent numbers, and it was cool, okay? And I closed several deals where there were a couple vacancies and the sellers left those units vacant on purpose as a marketing tool, as an angle to make it more valuable to the buyer, okay? Today, that's not the case, okay? Today, lenders want to see occupancy like the old school times, you know? They want to make sure these units are occupied. And guess what else? They want to make sure these tenants are paying the rents. Okay, we had a couple of deals we were working on for a client that we had to end up backing out of because there were vacancies, and which we thought were good because, okay, we know the rental market in the area, client can close, they should be able to lease these properties out real quick. Well, that wasn't the case with the lender because they're looking and saying, wow, there's just too much risk. There's too many vacant units, plus there's a couple of tenants not paying. I don't know, we don't want to do that loan. And so that kind of came as a shock to us. because only a year ago, if that was the same building, same situation, lenders would have loved it because we could have got in there and got market rents. But that was only the last couple of years, and that's why I say we're kind of getting back to the fundamentals. And I think the last few years, especially here in the Bay Area, Northern California, things got crazy in the rental market, man. So much so that lenders love vacancies because they knew you can go and get top rent. But now we're kind of getting back to the basics of the business where you got to have a certain amount of occupancy. And they want also what's called economic occupancy, meaning people paying their rent. So that's more and more critical, especially if you're going to be listing a property, you're going to be selling a property, you want to make sure you got your numbers together, you want to make sure you got your records together, you want to make sure your tenants are paying or you got a paper trail, okay? Or if not, you figure something out. We know one thing, it's hard for landlords right now. It's hard for tenants right now. It's hard for everyone right now. But particularly in the business, if someone is not paying, not only is physical dollars not coming into your bank account, that's affecting the value of the property, and it's certainly affecting the financeability of your property, whether you're selling it or even trying to refinance. Very, very, very critical. Okay, so vacancies are back to what they used to be, meaning that the property's got to have certain occupancies, both physical occupancy and economic occupancy, in order for lenders to make a loan on them. Now, the third thing I want to talk about in selling multifamily properties in this pandemic economy is prices. So look, the prices haven't crashed out, man. They didn't crash out, and I don't think they're going to crash here in the Bay Area, here in Northern California. However, they've softened a lot, meaning that, okay, a year ago, you put a property on the market, reasonably priced property on the market, you're going to get multiple offers quick. Okay, it's just the market was hot. It's just how it was. All right, this pandemic came out. A lot of people think, oh, the market's going to crash. Oh, it's going to, it's a little temporary blip. So I can tell you, being feet to the street to the marketplace right now, is the multiple offer apartments, by and large, multiple offers are not there right now when properties are being listed. All right, they're just not there. I'm not seeing it. Okay, but as buyers and brokers in the market every day, we're getting actually able to negotiate on deals. How about that, huh? You write an offer, maybe a little bit under the asking price, and people don't just throw your offer out of the window. They actually call you back. Who would have thunk it, right? Because the last couple of years ago, they wasn't really like that. Now we are able to negotiate a little bit, all right, on these prices, but they have not crashed out. And I don't think they're going to crash. I think they're going to settle. And I'll talk a little bit later in this video why I don't think they're going to crash, but they haven't crashed yet. I'm working with a couple buyers that were expecting to get these huge discounts off properties now. They're not there. I think there's flexibility, though, with sellers and opportunities to negotiate a favorable deal for yourself or for your client. That certainly exists right now. So what does that mean to the seller? If you're going to be out selling a property, well, bottom line is you got to price it right. And I think, again, it goes back to fundamentals. You got to price it right. In the last few years, we've gotten away from pricing the properties the way it should be versus pricing what the marketplace is going to pay for it. Because we look at a property and say, all right, well, it's a 5 cap. This is what things are trading for. This is what it should be. But we look at the price per unit and say, a building down the street sold for $300 a unit. Let's give it a shot. Let's give it a try. And you were able to, in some instances, get that. We're back to reality. All right? So your numbers have to match up with the cap rate, got to match up with the price per unit. You can't see what they sold down the street for and try to, push the envelope on it. You really got to look at the reality of the numbers and what's going to be feasible for the buyer. See, in times past, it's been like the greater fool philosophy. Let me just put this property on the market and I'm looking for a greater fool to overpay for this property. All right? I don't think that's a great model of success in general in selling properties. My philosophy is kind of leave a little bit of meat on the bone when you price it. And if you price it right, then you get multiple offers and you kind of take the highest and best offer. I think that makes sense. But what I'm saying to y'all now, if you're thinking of selling or you are selling or you're a broker, is that we got to price these properties the right way. You got to price it in the reality of what a willing and able buyer is going to pay for the property today. Because buyers got to look at it like, hey, there's a little bit of risk There's a little bit of risk out there right now. You know, you may buy a building. What happens if John and Sally in Unit A lose their job and they're not able to pay, and they have a legitimate COVID reason for not paying? Well, there's a little bit of risk. So what a smart buyer is going to do is price that into the deal. Now, there's still people in exchanges, still people buying opportunity zone property, still people just want to own property. And with the everything going on, it makes sense to own tangible real estate. But it's got to be priced right. So in regards to prices, they haven't crashed. They're settling out, soften a bit. And if you're going to sell a property, you have to price it right, based on reality, based on the real numbers, and what a willing and able buyer will pay you in today's marketplace. Not a year ago, before COVID affected all of our lives, right? Very, very important. Now, moving on. Number 4, rental laws have affected the business for sure. Like I said, I'm in the Bay Area. We got some of the most, I don't know who has more stringent rental laws than Oakland, San Francisco, and Berkeley. Maybe LA and Santa Monica might be at least equal. But I don't know, I don't see how it could be more stringent than what we have here. Okay, so what is happening is a lot of landlords are just stressed out by the laws because, first of all, they're changing so rapidly. To keep up with them is tough, it's difficult. And then the bottom line is, right now, somebody stops paying rent, you're not able to evict them. Eviction courts, they ain't even open right now. They're not taking your requests, all right? And then there's all these different laws that are changing. I'm not here to be a proponent for which law or that law. I'm just saying the laws are stringent and they are changing. Your marketplace may be different. You need to pay attention to it, though, because many places across the country, the government is saying, hey, look, you shut everything down. You can't just shut everything down and then say, people, pay your rent, because maybe you're out of business and they shut you down. Now you got to pay your rent. So what they're doing is not allowing these evictions to go through for now. Okay, and then getting rental increases approved right now. Good luck. I don't think they're doing rental increases right now, rent control or not. And then marketplace, if you're trying to get an increased rental amount, might be tough right now. Depending on where you are. In San Francisco, California, rents have actually came down. A lot of people moving out of the city. So in regards to these rental laws, though, they are changing. They are stringent. You are not able to evict people right now. We don't know when that's going to come out. The best bet is to have a healthy relationship with your tenants and negotiate what's fair and reasonable. Because at some point, what a lot of landlords are doing who are not getting their rent, they're tallying up all the balance. At some point, the tenants will have to pay. And what we're seeing in the marketplace, though, is tenants with low rents, they're playing like clockwork. They don't want to risk their rent control protection by not paying rent, because at some point, while you can't evict people today, at some point, the day of reckoning is going to come, and you will be able to try to collect on that. And what they're saying is you may not be able to collect 100% of that. It might be 25%, but you're going to be able to collect. And let's say that amount ends up being $10,000 to $15,000. We know people don't got $10,000 to $15,000. Well, the issue is most people still don't have 25% of $10,000 to $15,000 to be able to lump sum pay you for their rent. So, take it with a grain of salt. I advise working something out with your tenants. A lot of the landlords I'm talking to, smart folks, have done the same thing. You try to have an all-out battle with tenants. That's not really the way to do it right now. But you got to figure out a middle ground to where your tenants are there, rental income's coming in, and especially if you're selling the building, you got to be able to document it all. Because whoever the buyer or the lender is on the other side is, they're going to take a worst-case scenario approach, probably as they should, in underwriting your property. So you need to have everything written down. Because if they don't see it, they're going to assume this person's not paying, that person's not paying, this person's not paying, the seller wants to sell because he's losing money, blah, blah, blah. Say you're trying to sell and do an exchange. Well, you need to document what's going on at your property. Again, going back to fundamentals. That's a fundamental part of selling any commercial real estate is your numbers, the papers, the income determines the value of the property. So your paper trail, very, very important. But also, let me just leave with this on this one, rental laws. Be in compliance. Don't be that idiot landlord trying to evict somebody when you can't evict somebody, and then you serve somebody, and they get a lawyer and say, well, we're not only not paying you, we're suing you. Don't be that guy or gal. Make sure that you're doing things in a way where you're going to be in compliance with the rental laws, okay? No matter how stringent they are. I get it, it's tough, but something you gotta do. Last thing I want to talk about is seller financing and how that may be able to bridge the gap when you're selling properties. And here's what I mean, bridge the gap. You may want to get a price of here, and you can justify based on historical financials this price. But maybe the buyer is here because the buyer is looking at, well, I got to buy your building, but then the bank wants me to put 15% reserves on the sideline. So that takes away my available cash, so I'm going to put a discount on your price. Right? Let's just say. So a potential way of bridging that gap is maybe for the seller to carry a small second for the difference. Or maybe for the seller to do a wraparound mortgage. Or maybe for the seller to say, hey, well, maybe we can work something out. You buy an option on a property for a year to 2 years. You pay me a lease amount, and within a year to 2 years, you pay this price when things maybe loosen up a little bit. But what I'm saying is this, is I think that a lot of sellers have legitimate equity in their properties, meaning that when they bought their property, they put a money down, they had to qualify for the loan. It wasn't like the old market in the Great Recession where it was 90% financing for apartments. You didn't really have to qualify. They were underwriting things on pro forma. No, banks have been underwriting properties based on reality. They've been underwriting people. So if someone has equity in a property, I don't think that they're legitimately going to bail and walk like they did in the Great Recession. I think a lot of sellers are going to be creative, and I'm seeing that now. I've got 3 deals in escrow where there is an element of seller financing involved in the deal. And I did a video a little while ago about seller financing. You might want to see if you can click this video here to take a look and learn more about seller financing and how that might help your deal. And I'm talking from a seller's perspective. A lot of times sellers, I don't want to carry finance. But you want your price though, right? And if the marketplace is not going to give you your price based on, okay, maybe it's worth it, but the financing is a little bit restrictive, maybe the LTV is lower, maybe the buyer has to put more money down, maybe they have to put more money in the sidelines. Carrying some financing can get you what you want, you just may have to delay it. Also, carrying financing can be a favorable thing from a tax standpoint, okay? So there's a lot of different reasons why and how seller financing can help you to save a deal, to make a deal, to create a deal, to get something done in a difficult situation. And I think it's time for us as people in the selling position to get familiar with that. Brokers and agents too. A lot of brokers and agents just don't mess with it because they think they can't get paid. Bottom line is, I've done a lot as a broker, a lot of deals that involve seller financing in the old market, in the best of times, in the good market, now, and we get paid on them. You can get paid on them too. So just understand about seller financing. Like I said, check out the video I did on seller financing. That should be helpful. Now, I want, as a bonus, I talk about the 5 reasons or the 5 points to be aware of in selling multifamily properties during the pandemic. I want to give you a bonus, or just a word of encouragement. I like to keep it real with my viewers, my ecosystem, my database, but I always am looking on the optimistic side because that's just who I am. And the bonus I want to give to you is this. I think that there's still going to be significant demand for multifamily properties, particularly when you look at the capital markets of the world. The interest rates are so low. I think the T-bills trading at like just under 1%. That's crazy. That is crazy. You put some money in the bank. You put money in the bank, basically, you're losing money today, right? And with all the rates of return that are available in the marketplace being so low, apartments still, and always have been, one of the best investments that you can make. So I believe demand will be there. You know, I think you have to be creative to figure out how to work a deal. But if you can do so, you are making the right investment in buying apartments. That is my belief now. I believe, I believe that in the future that's going to be the situation. The caveat is this: you need to have an airtight operations plan, meaning how you're going to run your property. And a lot of people should be hiring property managers, by the way. But if you're going to run it yourself, you need to have a plan on how to deal with all this stuff. All right? People are dealing with it. Some people not dealing with it so good, but some people are dealing with it very, very well. So, but if you're going to go buy a new property, make sure you have an airtight operation plan. and you go out and build your multifamily portfolio. I hope this video helps. If it does, throw me a like, subscribe to this station. If you don't like it, give me a comment. I'm down for feedback. I want to have engaging conversations with y'all as we navigate through these pandemic waters, which we hope will be over soon. At least in the state of California, things are opening up again. I'm glad to see that. I heard 24-hour fitness, the gym, popular gym has opened up in several locations. I'm glad to see that. So let's just stay focused in this time, move it forward, and remember, multifamily property is still the best investment out there. Thanks a lot. We'll see y'all in the next video.